And it is another brutal day on Wall Street. The bloodletting seeming to continue here and catch not just the usual suspects. Yesterday, it was all about the semiconductor story, and or so the talking heads would tell us. Headlines and all, and the sell-off was concentrated in tech, and we saw the S&P 500 sharply lower. We saw the NASDAQ sharply lower. Today, the weakness is spreading. There is selling across all of the major indexes today. NASDAQ, of course, down again, albeit not as hard. The S&P 500 down again, but we are joined this time by the Dow. We are joined this time by the Russell, and the pain appears to be spreading. So, of course, the question that we ask ourselves now is, what comes next? This is Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. The focus for this move and its driving impetus is, of course, the major question. And as I've just hinted here with not a little bit of sarcasm, is that the conversation has been about whether what this is a reflection of some sort of idiosyncratic factors like valuations or the political narrative or some such other thing, or, as I might argue, a reflection of the changing winds in the global economy itself, as specifically pointed out in the way that the financial markets have been responding to incoming economic data and the impact of that economic data on expectations for what the Federal Reserve will do, and incidentally, the tone from the Federal Reserve in the days that we've been watching here. And so the first thing I want to do here is take a look just at the chart itself. This is the S&P 500, a kind of stand-in here for just overall market-wide risk appetite. So let's take a look here and consider. Because, of course, as ever, you can have any kind of narrative you want. If you're creative enough, you can pick and choose the right assets, the right headlines, and weave whatever tale. But at the end of the day, that isn't making of a trade unless there is evidence, whereby you can take that logic and extrapolate it to what comes next. So let's consider what is the structure telling us here and how we got to forming it. And through that lens, then figure out what is coming up ahead of us to shape the story going forward. So, needless to say, this is last week. And we come into, or the week before last week, as a matter of fact, beginning of July. And we can see here that we begin with a relatively spirited extension of the move higher, the same sort of post-digestion resumption that we've seen countless times in this rally, higher both from the lows in mid-April and, of course, here as well. So a bit of sideways digestion, a break higher, and we continue. This bar right there this little indecision bar before the big green candle up. That bar right there is the first day of congressional testimony from Fed Chair Powell last week, where he struck the most dovish tone that we have heard from him probably in at least the course of this year, but more accurately, probably for the past 9 months or so, since the Fed signaled that its rate hike cycle was over at the FOMC meeting on November the 1st, 2023. The Fed chair had been saying, we want to cut, but we want to see confidence that inflation is coming down. And because the unemployment rate is still low and the economy still looks relatively firm, we have all the time in the world. We can keep rates higher for longer, to use a familiar catchphrase. And on that basis, the markets understandably rallied. They got the sense from the Fed that the cuts that were coming were going to be maintenance cuts, that they were designed to follow the decline in inflation expectations, such that real interest rates are not unduly high. The real cost of money is, of course, nominal rates minus expected inflation. If expected inflation comes down and nominal rates stay the same, then real rates go up because you're subtracting a smaller number from those nominal rates. And so that runs the risk of over-tightening. And if growth is good, then what you're getting is the prospect that the Fed will not let things get too tight because maintenance cuts will come at the same time that the economy is strong. This is a very reasonable narrative for shares to go higher. But with that testimony, Powell pointedly changes his tone and says, we don't want to overburden the labor market. Now our risks between inflation and growth have come into narrower balance. Seemingly endorses easing, seemingly endorses the market's conviction at this point that the first rate cut is fully priced in for September. And the markets offer us this little wiggle here. They rise, and then when the testimony occurs, they come back down and close little changed. As if to say that for the first time in nearly 9 months, the markets do not want to celebrate dovish Fed guidance. There's a subsequent rally on the second day of Powell's testimony where he says nothing new, but then the tides turn right here. This big red bar that you see here, that is US CPI coming in softer than expected. And not only does the market not rally on that dovish cue, as it has tended to do before, it sells off sharply. As if to say, weaker inflation in the context of what Powell just told us, as data confirmation of whatever bias he put forward, now signals the Fed is becoming worried about the economic situation. Now the Fed sounds like it's worried about over-tightening. It sounds like it's worried about the business cycle. And after a bit of digestion with the weekend's news, certainly been a lot of back and forth here around the idea that what's happened politically in the U.S. over the weekend might be factoring into the gap that we saw at the open of the week right here in this little bit of follow through. But since then, after the weekend's political headlines were digested, we seem to have come back to whatever this was. And a washing out continues with some vigor. So if the sell-off now is motivated by concerns about global growth and U.S. growth in particular, well, then next week we are going to find in spades if this narrative holds follow-through potential. We begin next week with July's flash PMI data. As we can see here, this is giving us a whole range of expectations for the key global economies and economic growth there. These numbers are approximations of GDP. GDP data is, of course, notoriously lagged. And so this is a nearer term, more active way of looking at this. And we can see that the story is seemingly pointing in the direction of a little bit of improvement. So for the key economies, the Eurozone seen perhaps picking up a little bit of steam after the very disappointing numbers we saw in July. For the US, mostly unchanged. The pace of growth seen holding relatively steady. However, as we've seen out of all of the major economies, be they the G10 group, be they developing and emerging markets, or the catch-all global index, economic data has increasingly been underperforming relative to forecasts, and for the major economies and the globe as a whole, we are now below zero on this index, which is telling us that not only is data narrowing in closer to forecasts or surprising higher by a diminished margin, which would be, let's say, the story here, now we're actually tending to undershoot, which sets up for disappointing outcomes. We already saw that in June, the global economy marked its first deceleration in 7 months since shock of shocks, the point where the Fed said we're done raising rates right here. This is September, October, November of last year where we stabilize. We then go on a cycle of accelerating growth globally. You can see here, here's the 50 neutral level where there's neither growth nor contraction. We kiss it here in the fourth quarter of last year and then extend higher to show accelerating growth with improvements in manufacturing, improvements in the service sector, powering the rebound. But then in June, there is a course shift and the global economy begins to cool. If this finds follow through in July, well, we're going to be that much closer to a story that says we need to be worried about the business cycle. And as it happens, central bank policy expectations have followed suit. We can see there's been a general downshift in rate expectations over the course of the past month or so. Since the beginning of July, a downshift for Australia, a downshift for the UK, a downshift for the Fed, of course, a narrower downshift for the ECB. But of course, we just heard from them overnight here, and they sound all kinds of dovish and ready to continue cutting. September now expected to be when that occurs for the ECB. And of course, the Bank of Canada. Disappointing CPI data this week, 2.7 versus 2.9% year on year on that. Incidentally, as we expected here on Macro Money when we were talking about it ahead of the numbers at the beginning of this week. And not surprisingly, that has increased expected scope for Bank of Canada easing, which will be very interesting, of course, because they meet next week. So the next key point of fundamental event risk will be what does the Bank of Canada announce? Now, the current rate there, 4.75%, as you can see. The expectation that we are going to get rates to 4% almost by the end of the year. And so if you look at the implied change here, it's 63 basis points out of the 75 basis points that would amount to 3 cuts. So we're looking at an 84% chance for 3 rate cuts still to come out of the Bank of Canada. And of course, if the tone in the rhetoric here is as worrying as you might expect, given the data that we've just seen out of Canada vis-a-vis inflation, vis-a-vis the trend in disappointing growth figures more generally, especially out of the US, which of course Canada relies intimately for demand. 80% plus or minus of Canadian exports are US bound. Then a dovish Bank of Canada that gives us a rate cut next week, which is widely expected at this point. The probability is baked in 80 to 90% now, depending on when you look. We are looking at a situation that is perhaps a early indicator, or at least a confirming indicator, of signs of weakness in U.S. demand, all of which speaks to this global downturn concern that seems to be starting to bubble up. We'll get a view of U.S. demand directly because the next big item on the menu is going to be the second quarter GDP report. And here we're actually looking for improvement. The expectation is that we're going to get annualized growth of 2.5%, which would actually mark an uptick from the numbers that we just saw for the first quarter at 1.4%. And if we look at the way that the closely watched Atlanta Fed GDP now forecast or nowcast, in so much as it's updated in real time, we see how that's going. The expectation seems to be that actually the number might be even firmer than that. We can see CPI, of course, was a big washout for this. That was this massive adjustment from around 3% to sub 2% last week. But since then, it's a bit of a volatile chart, but we've come back to within striking distance of that 3% level. So what we're looking at this point is the expectation of growth at 2.7%, which is a little bit better than the forecast that we're looking at here. But of course, the question is, how backward looking is this? Because if you then look at the ISM data that came out recently, then we see that conditions in June gave us the first monthly contraction in both services and manufacturing since back here, December of 2022. And of course, what we see through the second quarter is much more of a well-supported economy. As a matter of fact, manufacturing is actually improving a bit into the second quarter here, while services holds mostly intact. So you would expect that the second quarter numbers would be relatively okay, but that would not change the idea that since then, some sort of a turn has materialized. Indeed, we can see U.S. economic data is moving in line with those averages that we just saw for the world as a whole. So here is major economies, emerging economies, and the global economy from about mid-April to May, topping out and starting to disappoint. Here is the same story for the U.S. Mid-April, topping out, starting to disappoint. The final bit here, the U.S. PCE inflation data. This is the Fed's favorite inflation gauge. Both core and headline expected to come down a little bit, from 2.6 down to 2.5% on both. Of course, we know that CPI surprised on the downside, so there could be some room for this to do the same. The real critical question here, of course, will be if GDP appears dated and this disappoints in line with the recent numbers that we've seen out of the US and the global economy as a whole, what does that do here? And if what we find is this initial support here somewhere above 55 50, 5,600, where we have these tops here that acted as a range top being retested. If this gives way on the downside, and if it gives way with weaker data, especially on the inflation front, it is not maintenance cuts benign for stock markets that we are angling for. And the narrative has changed concretely to an expectation of a global downturn, which is a whole other kind of thing with scope for stocks to continue lower. And that is macro money for today. We are off next week. We'll be back the week after, as usual, Monday through Thursday after overtime, show that I co-host with Chris Vecchio and Dylan Radigan. I will be likewise off for the Price of Truth next week, but back on Wednesdays the following week as usual. Same for First Call, a show that I do with Victor Jones and Tom on Sundays for the market open. I'll likewise be back for the Price of Truth, or for Futures Power Hour, on Fridays upon my return. In the meantime, I will be opining sporadically as markets move on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Good luck trading.